Welcome to this explainer. Today, we're jumping right into the fascinating and honestly absolutely crucial world of IAS 36. We're going to be looking at how companies diagnose and treat impaired assets. We're talking strictly about the rules for when an asset's value on paper just doesn't match up with reality anymore, and exactly how we go about fixing that discrepancy.
Okay, so here's our roadmap for this explainer. We'll start by recognizing impairment indicators, move on to the actual impairment test, and then calculate the recoverable amount. After that, we'll look at cash-generating units, figure out how to allocate impairment losses, and wrap up with reversing those losses. Let's get into it.
Starting off with Section 1, Recognizing Impairment Indicators.
Now, what's really interesting here is that for certain assets, specifically goodwill, intangible assets under development, and intangibles with indefinite useful lives, you don't even wait for the symptoms to show up. You literally can't systematically amortize these, so the accounting standard forces us to be proactive. You have to test them for impairment every single year, completely regardless of whether any warning signs actually exist.
But for all your other assets, we're basically playing detective, looking for triggers. These fall into two buckets. You've got internal indicators, like physical damage to a machine, or maybe it just isn't performing economically like it used to. And then you have external indicators. These are your market shocks. Think about a sudden crash in market value, major legal changes, or interest rate hikes. Like if a massive new AI tech suddenly hits the market and makes your older equipment instantly obsolete, that is a glaring external indicator, and it forces you to test your assets right then and there.
Which leads us perfectly into Section 2, the impairment test itself. Simply put, if your asset is sitting on your balance sheet at a higher value than what you can actually claw back from it in the real world, well, you've got an impairment loss. The carrying amount is what your books claim it's worth, but the recoverable amount, that is reality knocking at the door. So, you might be wondering, how exactly do we calculate this recoverable amount? This brings us to a fundamental teeter-totter concept in accounting that you absolutely must master. It's the core of IAS 36. Get this wrong, and honestly, the entire impairment calculation just falls apart.
Let's break it down in Section 3, Calculating the Recoverable Amount.
The absolute golden rule here is that the recoverable amount is strictly defined as the higher of two specific values. Why? Because a rational business is naturally going to choose the best possible financial outcome. If keeping the asset makes you more money, you keep it. If selling it makes you more, you sell it. You always pick the higher metric.
And that gives us our two options. First, the open market route, which is fair value less cost to sell. Second, the internal operational route, known as value in use. Now, listen closely here, because there are strict exclusions. You must keep finance costs and tax costs entirely out of the math. If you're going with value in use, make sure your residual value is included in those present value cash flows. And for a fair value, remember that transportation costs are already baked in. They're deducted from the market price before you even look at subtracting those incremental disposal costs.
Now, let's move to Section 4, Cash-Generating Units.
Okay, things get a little tricky when we're dealing with a complex system. What happens when a single asset, like say an office laptop, can't actually generate independent cash flows to calculate its value in use? I mean, we can't calculate a recoverable amount for something that doesn't make money on its own, right? A single laptop in the HR department doesn't exactly print cash by itself.
In these cases, we have to look at what's called a cash-generating unit, or CGU. This is the absolute smallest identifiable group of assets that generates independent cash inflows. So you'd group that laptop with other assets into a CGU, and you test that entire integrated group for impairment together. By zooming out to the smallest group that actually brings independent cash through the door, you can finally calculate a meaningful value in use. And boom, you have your recoverable amount.
All right, moving right along to Section 5, Allocating Impairment Losses.
When a CGU is actually impaired, you can't just allocate the loss randomly. It has to follow a very strict waterfall allocation. Think of it like a cascading waterfall of loss that drowns specific assets in a highly structured, unchangeable order. You don't get to just choose which assets take the hit. The standard dictates the exact sequence. You literally have to follow this three-step triage to the letter. Step 1, apply the loss to any specifically obviously impaired assets first. Step 2, completely wipe out the carrying amount of any allocated goodwill. Goodwill basically acts like a giant sponge here. It absorbs the impairment until it is totally dry before anything else gets hit. And then step 3, allocate whatever remainder of the loss is left pro rata, or proportionally, across all the other applicable assets in the unit, based on their carrying amounts. Now here is a massive caveat. While items like inventory and trade receivables are absolutely part of the CGU's total carrying amount, we actively shield them from that final pro rata allocation step. Why? Because those assets are already governed and impaired under their own specific accounting standards. Inventory falls under IAS 2, receivables under IFRS 9. The golden rule here is we do not double impair them under IAS 36.
And that brings us to our final part, Section 6, reversing impairment losses.
So let's say things get better. You actually can reverse a past impairment, but there's a strict ceiling. The maximum reversal is the lower of two things: the new calculated recoverable amount versus what the asset's historical carrying amount would have been if the impairment had never even occurred. You can't just magically inflate the asset's value. You have to pretend the impairment never happened, calculate its normal, depreciated book value for today, and you can never ever cross that line.
Okay, so we know we can reverse losses for standard assets, but what about goodwill? Goodwill is the one major exception to this recovery rule, and you absolutely must memorize this. While your standard property, plant, and equipment can totally bounce back, goodwill plays by a totally different and, frankly, much harsher set of rules.
Goodwill, once impaired, is impaired for life. Once that waterfall of loss we talked about wipes out goodwill, the accounting standards flat out do not allow it to be revived. Think of it like this. Once goodwill gets drenched in the colors of impairment, that stain never washes off. It's a completely permanent reduction.
0. That is exactly the amount of a goodwill impairment loss that you can ever reverse. None. Which really leaves us with the ultimate question. How accurately is your company diagnosing its assets today? Are you proactively catching those early internal and external indicators? Or are you just waiting until that impairment waterfall completely wipes out your goodwill? Take these rules back to your own balance sheets and start testing.